Hey guys, read the disclaimer before you start out the video. In this video, I'm going to look at some of the markets. I'm going to look at Nifty mainly, and I'm going to view out how the market behaved in the past week, and I'm going to review the past week performance. And the method which I'm going to use here is completely different from basic price action and indicators. This is a video which, in order to give you an awareness about other price action trading methods such as the SMC or the institution trading method. You might be a trader using the basic price action or the retail support resistance. But you need to understand that there are methods other than the basic retail price action and the basic retail support or resistance. So if you are a trader who is trading based on indicators, you must shift from indicators and look for more advanced price action methods in order to increase your probability. But what I'm going to talk here is I'm going to talk about the basic logic of a trader which you can use in order to have an edge in the market without using the basic methods as indicators or price action. So moving forward, you can see that the weekly chart of the market which I'm using is Nifty, and I'm looking at the weekly chart right here. So when you look at the weekly chart, we had a sell-off right here. We had a great sell-off here, and after that, the sell-off, the market has been giving a huge rally from this particular point. So my daily bias from the past week was the market will be having a bullish view. But how I had that view, how I had that conclusion that the market will be bullish. So I'm going to give you an example of what the market had, the behavior of the market in the past week. So if you look at the weekly chart, you can see that whenever the retail traders, they have the concept of support or resistance, which can be called as the roof or ceiling of the market. So if you see here the market, this right here, this is an equal low. This right here is an equal low. The market created an equal low right here. This is, if you look at the higher time frames, and when you set up your daily levels, you might consider this as your weekly support or resistance. This is your weekly support, right? So in the retail mindset, this is your weekly support. But if you look at this setup, the smart money people, what they try to do is they try to take your liquidity, they try to take your stops before going up or before going down. So in this case, you can see that we had an equal low right here. We had an equal low. You can call other concept as well, but I'm going to talk about the equal low concept. So we had an equal low right here. The market took liquidity below the equal low, and the market has been rallying from that particular point. You can see that even if you look at the forex, the crypto, or any other index, you can see that the same is happening in any other index as well. But even if you focus on the Indian market, the bank Nifty, the Nifty, you can still see this happening in the market in the higher time frames such as the weekly, and even in the lower time frames such as the 15-minute. You can see these things happening over and over again. And this is the concept which you need to understand. So you can see it here with the basic common sense. You can see that the market took the support, broke the support. This will be a great break in the lower time frames. In the weekly, this is just a week, but in the lower time frame, this will be proper great move. The market took the liquidity, went up from this particular point. I had the bullish move right after the market close. I had this particular move that the market will go up from this particular point. I had that view. I had that daily bias. I had that weekly bias. So from this point, the market took the liquidity, and again, I'm going to show you the example. You need to just keep this in mind. The market took the liquidity from an equal low. The market broke the area, took the liquidity from the downside area, and went up from that particular point. And I'm going to show you example again, which happened in the last week on a different time frame. So I hope you had this concept here. So you can see that this was the break in the lower time frame, which is the 1-day time frame. In the hourly time frame or the 15-minute time frame, this can be a great break. And if you're a trader based on an intraday trader, you might initiate a position right here, and you will be stopped out. So this is the daily time frame. The market went up, great move right here. So from this particular point, before the week start, my weekly bias was the market will go up from this particular point. Right in this candle, my view was the market will go and have this particular view, this particular move. And I'm not going to uh, complicate things, and I'm going to simplify things with the basic common sense. So you have seen that 1 week time frame where the market take the liquidity. And I'm going to show you again this concept. So in the 1 hour time frame, this right here, this is the candle which I'm looking. So in the 1 hour time frame, you can see that we had an equal low again. So I'm not going to complicate things and talk about market structure, but at this particular point, the market was going down. This was the fair value gap. This was we having a gap. Again, the market was going down. And again, when the market were continuously going down, it created an equal low. This can be considered as a key level for a retail trader. They might scalp the market from this particular point. They might take a support breakout trade from this particular point. They might see a volume in the 5-minute candle chart, and they might initiate take trades from this particular point. But when you see areas like this where the market broke an equal low or an equal high, there is a high chance that this can be a liquidity trap. This can be a trap where the market set up to take your stop loss before the market make a huge move. So you can see that from this particular point, the market had the equal low here, right here. The market broke this equal low where the retail traders enter, and you can see that the market went opposite to that, right? So whenever, if you are someone who is holding the market from here, if you're a retail trader, your stop loss will be below this particular point, right? So you can see that at this particular point, the market broke this the equal low, took the liquidity right here. Again, you can see that this is a gap. The market came to created a gap here. The market went back down again, and the market went up from that particular point. So this is how you have that concept. So I'm going to show you again that with the gap concept. So you can see that the market took the liquidity right here. The market went up, creating huge candles. The market went up. This area was not tested. This area, there was orders present at this particular point. The market went back down, took the liquidity and went up from this particular point. So I'm going to show you the concept. You can see that this things happens over and over again, even in the lower time frame, even in the high time frames. This things keeps happening again and again. And if you are in the right place, in the right time, you can capitalize on these moves. So you can see that the market took the liquidity, created a gap, went back to the gap, tested the gap, and the market had a huge rally. So my execution time frame is the 3-minute, and I'm going to back to the 3-minute. This is the gap which I drew on the 1 hour time frame, but I'm not going to refine it here. I'm just going to keep it like this. The market went back down, tested here. If you're entering here, you can see the reward which you are going to get. So as a trader, with your basic common sense, with just simple trading tools, just few horizontal lines and just few understanding about the concept, you can be profitable without indicators, without complicating things with price action. By looking at the previous week or the charts, looking back to the charts and telling that it happened like this and that, it might be simple, but you can see that happening in the future as well. If you look at the weekly chart, you can again see a what I would say equal high or low again. I'm not going to plot that, but you need to understand that how the market is going to react from this particular point. So if you look at the charts, I have traded with price action. I have traded with basic retail indicators, and I know the concept. It doesn't make any logic on why this particular move is happening, how the particular move is happening. You can see that this is a textbook move, which is really, really simple and really simple to execute. So this method, if I don't know whether upload more videos. I don't know whether I will do it or not. If I start to do that video again in the future, I'm going to show you again this same concept happening in the market again and again. There are people who control the market, and if you have that understanding that there are people who control the market and you can capitalize the market, if you have the proper concept, you can win in the market. So this is the basic concept about how the market had the great move the past week, and my daily bias or the weekly bias for this particular week is already set, and I have the concept on that as well. So this video is not to teach you something or sell you something. This video is simply to tell you that if you're a retail price action or indicators, there are methods other than this basic things. There are methods other than the retail price action and indicators which you can use to capitalize the market, which makes more sense. So this is to give you back that there are methods other than the retail price action and indicators. Thank you so much for watching this video.